I want you to imagine something. You've spent 30 years working, saving, sacrificing. You skipped vacations. You drove the same car longer than you wanted to. You put money away every single month because you were told that if you just saved consistently, retirement would take care of itself. And now you're here. The account is healthy. The balance looks good. You're finally ready to stop working and start living. And then, in your very first year of retirement, you get a tax bill that makes your stomach drop. Not because you did something illegal, not because you made a reckless investment decision, but because nobody, not your bank, not your financial advisor, not the government brochure they handed you, ever sat you down and explained what actually happens tax-wise when you start pulling money from a non-registered account in retirement. This is happening to thousands of Canadians every single year. And the worst part is that most of these mistakes are entirely avoidable if you know what to look for before it's too late. Welcome to Canada Alert Network, where we exist for one reason and one reason only, to make sure that hardworking Canadians don't lose what they've spent a lifetime building because of information they simply never had access to. If you're new here, subscribe right now because the content on this channel is the kind of stuff that genuinely changes financial outcomes for real people. Not theory, not textbook examples, real Canadian tax situations that real Canadians are walking into without any warning. And if you've been part of this community for a while, you know we don't waste your time. Let's get into it. So first, let's talk about what a non-registered account actually is in this context, because this mistake catches people who have done everything right on paper. A non-registered account is simply any investment or savings account that doesn't have a registered tax shelter attached to it. It's not your RRSP. It's not your TFSA. It's the account you opened at your brokerage because you'd already maxed out your registered room, or because someone told you to keep some money accessible, or because you inherited it, or because you've been building it quietly for decades alongside your registered accounts. And it looks fine. It looks perfectly normal, until you start drawing from it in retirement, and the CRA shows up in a way you were absolutely not prepared for. The first and most costly mistake retirees make with non-registered accounts is misunderstanding how capital gains are triggered and timed. When you sell an investment inside a non-registered account, that sale triggers a capital gain or loss in the year the sale occurs. That sounds simple, but here's where it gets dangerous. Many retirees sell large positions in a single calendar year to fund their lifestyle, not realizing that stacking those capital gains in one year can push their net income into a bracket that triggers OAS clawback. The Old Age Security Recovery Tax, which kicks in when your net income crosses a threshold that the CRA adjusts annually, is essentially an additional tax on your retirement income that can quietly shave thousands of dollars off what you thought you were going to receive. And it is almost entirely preventable with proper timing and sequencing of your withdrawals. But nobody warned you to spread those sales across multiple years, so you didn't. The second massive mistake is ignoring the adjusted cost base, or ACB, of your holdings and what it means for your actual tax exposure. The ACB is what you originally paid for an investment, adjusted for things like reinvested distributions over the years. The gap between your ACB and the current market value is your capital gain, and only 50% of that gain is included in your taxable income under current Canadian tax rules. But here's where people get blindsided. When you've held investments for a long time, sometimes decades, and you've been reinvesting dividends and distributions the whole way, your ACB calculation becomes genuinely complicated. If you get it wrong, and a lot of people do, you could be paying tax on gains that aren't actually gains, or you could be underreporting, which creates a different problem entirely. The CRA expects you to know your ACB. Your brokerage statement does not always calculate it for you correctly, especially if you've transferred accounts or held positions across multiple institutions over the years. The third mistake is treating dividend income from a non-registered account as if it behaves the same way across the board. It doesn't. Eligible dividends from Canadian corporations receive a dividend tax credit that can make them quite tax efficient at certain income levels. But foreign dividends, particularly those from U.S. stocks held in a non-registered account, are taxed as ordinary income and are also subject to foreign withholding tax. Many retirees hold U.S. dividend-paying stocks in non-registered accounts when those same stocks would be far more tax-efficient inside a registered account, particularly an RRSP, where the Canada-U.S. tax treaty eliminates the withholding tax. The account location of your investments matters enormously in retirement, and it's a lever that most Canadians have never been taught to pull. The fourth mistake, and this one is painful to watch, is withdrawing from the wrong account at the wrong time in retirement. There is an order of operations to drawing down your retirement savings that can save you a staggering amount of money over a 20 or 30-year retirement. Drawing too heavily from your non-registered account early while letting your RRSP grow can lead to massive, forced RRF withdrawals in your 70s that spike your income and devastate your OAS, your GIS eligibility, and your overall tax position. Drawing too little from non-registered accounts early, when your income is low and your marginal rate is low, means missing the opportunity to realize gains at a lower tax rate than you'll face later. Getting this sequencing right is one of the most valuable things a Canadian retiree can do for their long-term financial health, and it requires a plan, not a guess. The fifth mistake is the one that ties everything else together, and it's simply the absence of a written year-by-year income projection that maps out what your tax situation is going to look like across your retirement. Most Canadians retire with a rough idea of their monthly expenses and a rough idea of their account balances. What they don't have is a clear picture of how drawing from those accounts interacts with CPP, OAS, potential RRIF minimums, and the progressive tax system year by year. Without that picture, every financial decision in retirement becomes a guess. And in the Canadian tax system, guessing with a non-registered account is one of the most expensive habits you can have. You've worked too hard and too long for any of this to catch you off guard. The good news is that every single mistake I just walked you through is avoidable. Not after the fact, before it ever happens, with the right information and a real plan. At Canada Alert Network, this is the conversation we are committed to having week after week because Canadians deserve to retire with confidence, not regret. If today's video opened your eyes to something you hadn't considered, please hit that like button. It helps this channel reach more Canadians who need this information right now. Subscribe if you haven't already, and turn on notifications because the next video in this series is going to go even deeper into RRIF withdrawal strategy and why most retirees get it completely wrong. Drop a comment below and tell me which of these 5 mistakes hit closest to home. I read every single one. Until next time, stay sharp and protect what you've built.